If you are worried that you won't be able to fund your business, what I'd like to remind you of is that everything is absolutely figure outable and you have options. So today you have joined us for our monthly webinar in which we bring in experts to talk about topics relevant to business owners and entrepreneurs. This quarter, we have been sponsored by Pay Forward. So we are so thrilled to have you here today with us, Eric. We're going to send this off to you in just a minute, but I wanted to introduce a little bit about everybody here. So Aviatra, I'm Jasmine with Aviatra Accelerators. We're a nonprofit, and we support women entrepreneurs. And today we are thrilled to have CEOs and founders, Jake Whitman with Really Good Box Wines, and Marvin Abrinica, forgive me if I messed that up, with Wunderfund. And they're here to share their expertise and their experience with crowdsource funding or public funding for today's topic, which is how to harness the power of crowd. We will go ahead and save all questions for the end. So if you've got them, go ahead and stick them in the chat, and we'll let everybody share other things, and then we'll talk about all of the questions. So Eric, please tell us a little bit about Pay Forward. We'd love to hear from you.
No, great. I appreciate you having us, Jasmine, Jill. Always great to attend. I'm really, I'm interested. I wasn't able to make the last webinar here in the crowdfunding, so I'm really interested to listen in on this one today too. But I'm Eric Monks, the president of Pay Forwards. We are a full service payroll provider here in Louisville, Kentucky. Specializing in the small to medium sized business market. Love working with Aviatra and other groups similar here, throughout Kentucky with startups, small businesses, medium sized businesses. Whether you're looking to maybe start, outsourcing your payroll process, your tax filing process, need some time and labor and HR technology, we're here for that. But also just if you have general questions, it's something that may come up for you in the future and you want to bounce some questions off us, we're happy to provide feedback, even if it's 6 months, a year, a couple of years down the road for you. We look at it as just, our role as a small business ourselves to help educate the community and anxious to help you out whenever we can. So no, again, appreciate you all allowing us to sponsor some of these events and looking forward to listening here.
Well, we are so grateful for you. So to get started today, I'd like to introduce Jill Morenz, President and CEO of Aviatra. She is going to go through and review some of the foundational information about crowdsourcing to ensure that you all have what you need to be ready for the conversation today. So Jill, I'm going to let you take it away.
Thank you so much. Okay, so I really had a great time digging into the options for crowdfunding. And as Jasmine mentioned, we have 2 experts to talk about it also, but I wanted to give an overview of kind of the landscape and the types of crowdfunding platforms that are out there and the differences between them. So I'm going to share my screen here and do a quick slideshow for you.
Beautiful.
Okay. So I put in the chat the link to our free download. It's an overview of basically a summary of these slides and the presentation. But if you would rather use the QR code, feel free. There it is. So we're going to talk about the 4 types of crowdfunding. So we have equity-based, rewards-based, debt-based, and donation-based. So let's talk a little bit about each one. So equity-based crowdfunding, so the backers become part owners of the company. So it's not not a donation or not in exchange for any goods. They are actually going to be part owners of your company. And that's what actually Jake and Marvin are going to talk about, that kind of crowdfunding. The backers, a couple things to think about when you go for this kind of funding is, do you want to share ownership of your company? It oftentimes comes with really expert help to grow your business because the investors, have a vested interest now in the success of your company. And so it often comes, as I mentioned, with really great advisors. But the expectation is that you will sell the company. Generally speaking, 5 years, I think, is probably, Marvin can talk to that, but I think that's probably the target that they're looking for. So if this is a company, if you have a company that you're building for the long haul, like to work in for the rest of your life, to pass on to your families, then this is not the right source of funding for you. Here's some examples. So Wunderfund is where Marvin is from, and so we'll hear more about him. Start Engine is the organization that Jake got his funding from, so we'll hear more about that as well. Other ones are WeFunder, EquityNet, and Fundable. The second kind of crowdsourced funding is rewards-based. So this is probably what you've heard more of. This type of thing is if anybody can be a part of this crowdfunding. So if you go on a platform like Kickstarter and you sign up to give money to the company, usually there's different levels, and at each level you get some kind of a reward. So it might just be a thank you card on a lower level, all the way up to coupon code or for discounts on whatever it is, the product that they're trying to fund, or the product itself. So it could also be like a pre-order system for you. So the backers get rewards, and the business owners, the challenge there is that they have to figure out the balance between incentivizing the backers with a great reward, but not going too far and making it the rewards be too expensive so that it kind of offsets the money that they got from them. Examples, as I mentioned, Kickstarter, then there's Indiegogo, Fundable, and Campfire are two other ones. The third type is called debt-based crowdfunding. So this is when the money comes to you in the form of a loan. So it's usually a low interest loan, not always. I mean, lower than a credit card, right? So if this might be the way to go if your other alternative is a credit card. But of course you do have to repay it. Otherwise your credit score will suffer. Kiva is a platform that is a more unusual type of crowdfunding platform, donation or debt-based, where the loan is actually 0%. So it's just the money. You only have to repay the money that you borrowed, no extra interest. But Fundera and Funding Circle are other ones. And then the fourth type is donation-based crowdfunding. So this is free money. You don't have to repay it. You don't have to, trade a share of your company for it. But it also, by the same token, is not usually used for business financing. So an example of this is GoFundMe. There's some other examples, but GoFundMe is the type where, I'm sure you are familiar with this, where people who have to have an expensive surgery, who can't afford it, they might put up a GoFundMe page and people donate, toward their surgery, $10, $20, something like that. So it's really meant to be a little bit more cause focused or personal needs focused than business focused. Now, Patreon is a little bit of an outlier here, where that is generally meant to support creators. So artists, speakers, content creators, musicians, they often have patrons, and who are the people that support them with regular monthly payments, sometimes as little as $1. And that just goes to help support the work that they do. So it is business related, but you have to get followers who want to donate monthly to support you. And that is the end of my overview. So I think next it would be, I'm going to kick it back to Jasmine and she'll get the rest of the presentation started.
Terrific. Thank you so much. That was really helpful. A nice big overview. And that's gonna help us all understand everything a little bit better today. Jake, I would like to invite you to share your insights and expertise. That is going to be, we're really quite thrilled to have you today. And don't,
Now I'm unmuted. We good?
beautiful. You caught it. I was about to help out, but you're on it.
All right. So nice to meet everyone. Thank you to AVHA for having me. My name is Jake Whitman. I'm the founder and CEO of a company called Really Good Box Wine, which is exactly what it sounds like. I'm going to I'll tell you a little bit about the business, but I'm going to focus most of this into our experience crowdfunding. But what I'll say two things. One is a lot of this is my sort of personal opinion about this space and sort of what I've sort of come to know about crowdfunding in my research and then going through a crowdfunding process. And the second thing I'll say is, if any of you are really thinking about kicking off a crowdfunding campaign, please do reach out. Like, I asked for hundreds of pieces of advice and favors and stuff like that during the very early days of my businesses. And I love to repay it. So please do reach out. My email's here. I would love to chat about your business. So, okay. So quick overview on what Really Good Box Wine is. Our whole mission is to bring fine wine into the future. So, box wine notoriously is known as sort of a lower quality format. It's sort of the cheaper wine that you have either, for cooking wine, or it's just sort of a less expensive wine. But there's actually no technical reason why you can't put amazing wine in a box. Producers just don't do it. And it comes with these incredible benefits. Like when you open it, it stays fresh for 6 weeks. So there's no dumping half a bottle that you don't finish in a couple of days, or forcing you to drink 5 full glasses of wine, which, I'm trying to practice more moderation myself, and a lot of people are as well. So, it's nice to not be kind of forced into that. The carbon footprint's also an 85% reduction versus bottles. Our packaging costs are about 90% lower versus bottles, so we can pass those savings on to the customer, and all of the packaging like styrofoam and stuff that protects glass are all really expensive. So what you come out to is we're producing wine that would sell for $30 to $40 a bottle, really beautiful handcrafted wine, no additives, just working with some really premium vineyards across the West Coast of the United States. But we're able to sell it for about half the price and ship it right to your door. So we do most of our sales direct to consumer. We are rolling out more and more into wholesale right now, but about 90% of our sales to date have come as an e-commerce brand, and we ship to 45 states across the country. So that's kind of the very quick snapshot into our business. Okay, so these are the kind of the topics I'm going to chat through. I may move a little quickly. I think I went a little long in the one a week ago, so I'm going to move a little faster through it. But if you do have questions at the end, please raise your hand. So the first is, why crowdfunding? Then what are the different types of crowdfunding platforms? I'm focused a little bit more into the equity side. So this is a little bit of like a click into equity from Jill's presentation. And then I'll talk through our background, our process, and the results. The one thing that I will kind of caveat here is this takes a little longer than you think, especially on the equity crowdfunding side. So if you need money like tomorrow, this may not be the right process. And I'll talk a little bit through the exact process, but it's really rewarding and I think really powerful if you do kind of spend the time to build the campaigns. So why crowdfunding? There's a few really great reasons. One is it creates hundreds of loyal customers and ambassadors. We have about 450 investors that came in through the crowdfunding campaign, and many of our additional customers have come through their recommendations. They're almost like brand ambassadors for us, right? And some of them we talk to at a more strategic level. I'd say most of them have just really become passionate customers of the brand and kind of share the brand with their friends because they're now motivated to help us succeed. So it really does create a lot of momentum there. It also allows retail investors to participate. And I know Marvin's going to talk a little bit more about this, so I won't go as deep into this piece of it. But for most equity investing, you have to be an accredited investor, which means you need to be basically a high net worth individual. And in 2012, a law was passed called Regulation CF, that allowed retail investors to participate with some kind of restrictions on top of it. And that's sort of where this equity crowdfunding industry was born from. The third one is, and I think that this is more just a nice to have versus a requirement, but it's really great for consumer brands for kind of the reason, for kind of the bullet one reason, right? You have, it's when you're a B2B business, the power of the crowd can be helpful, but it's much more acute, I think, when you have people out there who are actually purchasing your product and are sharing it with their friends who may not be in the industry directly if it's a B2B type business. Not that this can't work for B2B businesses. I just think it's particularly helpful for consumer. And then the fourth is it's just genuinely more accessible than angel and VC, especially VC, right? Very few people have direct relationships with VCs. You hear the horror stories of cold pitching 100 VCs and getting 99 no's and spending 6 months of your life doing it. And so, it really is a more accessible way to fundraise. I think, like anything, it's good to know some of the potential downsides and consider them. One is it's not usually strategic capital. Sometimes you do get some people in who can be advisors, as Jill was mentioning, but the majority of people in are not going to be the angel who has deep experience in your industry and has decided because they believe in what you're doing, they're going to put a sizable stake into the business and sit on your board of directors or advisors or something, right? It's really not typically strategic capital. That can be a good thing. Sometimes that means you don't have people breathing down your neck to go hit certain results. So that's not always a bad thing. Fees can be high, certainly higher than if you're raising through non-platforms. These platforms take both a percentage of the raise in cash, and then also some of them also take an equity stake in the business on top of whatever you raise. And then there is some risk of stigma about this. I think personally that it's overblown and it's become a much more acceptable way to raise money for a business these days. But I was cautious about this at the beginning, and through lots of conversations with people, came to be very comfortable and actually excited about it. But there is, I think, a potential risk of stigma if you're going to continue on raising larger sums of money from VCs and stuff like that. So it's just something to kind of think about. Okay, here are the types of crowdfunding platforms, and the two on the left are a click into equity, and then there's kind of the non-equity side, which is all the others that Jill was talking. So there's sort of two ways to think of equity crowdfunding. There's these open platforms, which is essentially a platform where, with some relatively low barrier to entry, virtually anybody can put their business up to raise money. So this is WeFunder and Start Engine are the two biggest ones. We raised from Seed Invest, not Start Engine. So we're on the closed platform. And since then, Start Engine has bought Seed Invest. So Jill, you were sort of correct that we have technically raised from Start Engine. But this is the platform that you may have hundreds of companies that are all raising at the same time on these platforms. So the pros here typically are lower fees and lower barrier to entry. There is some barrier to entry. They require certain revenue levels and goals, and you have to put together projections and stuff like that, but it's relatively low. The cons are it can be hard to break through, right? Like if you have hundreds of companies on a platform, you sort of have to find creative ways to get money in the door that doesn't come from just people that you're directing there. And you really can't rely on the platforms themselves to do that for you. On most of these, they do have like spotlighted companies that show up, or like top funded companies that show up, that go up in their email newsletters and stuff. But those are usually part of a campaign and are usually sort of part of the strategy of launching. And so it's hard to rely on the platform for this. The other side of it is these closed platforms, which are Republic is far and away the biggest in this space. Seed Invest is another one that was ultimately purchased by Start Engine about 9 months ago, maybe. And the way these operate is you may only have 5 to 10 businesses on the platform at any given time that are raising money. So the way this works is you apply and you go through a real due diligence process. So I think we had a month of due diligence. We maybe answered 150 to 200 questions at several rounds. We had to be approved by their deal committee. And they state that they take about 1% of applicants and to ultimately put them onto the platform. So this is much more of it has sort of a blend of crowdfunding and VC in it, because you're really going through a deal committee and ultimately they're sort of approving the investment. So the pros here are sort of clear, right? The much less competition. You've got 5 brands instead of 100 potentially. And the other thing that was really nice about working with them is there was active platform participation. So we had a venture analyst who they assigned to us that basically led the campaign for us internally within our Seed Invest campaign. They were reaching out to investors on our behalf. They had about 650,000 people who they were reaching out to, and which also became a marketing campaign, because even if those 650,000 people didn't invest, they had maybe 15 or 20 different exposure points to the brand over the course of a 2-month period. So those are the pros. The cons are is definitely higher fees. I think my fees were 2 to 3 times higher than they would have been on a WeFunder or a Start Engine. We ultimately decided to think of those fees as a marketing expense because of the reasons we were talking earlier. And so we're able to sort of justify it that way, but it was not an inexpensive source of capital. And then it's just very selective, right? So and it's a long kind of process to get approved. So those are some of the cons for those platforms. The third, and I'll speak less about these, but there's all the other non-equity side. Kickstarter is definitely the most well-known, and then maybe GoFundMe. With the pros here is you're not giving up any equity. You maintain 100% ownership of your company. And then something like Kickstarter, the format of the legal format of Kickstarter is actually a pre-sale, right? And so you're typically saying, if you give me $50, I'm going to give you a product that's going to cost the rest of the market $75, which gets pre-sales out the door. It also puts product in people's hands and has sort of a set customer base as soon as you launch. The cons are similar to the open platform. You might have hundreds and hundreds of companies on there, so it's going to be really hard to break through. And I think it's hard to raise large amounts of money this way. There are the stories of people who went viral and raised $500,000 on Kickstarter, but most people are looking to raise, $10,000 to get the product off the ground, or even 25 to 50,000, which is not an insignificant amount of money, but certainly isn't the hundreds and hundreds of thousands that some of these equity crowdfunding platforms can raise. Okay, so I launched the business in April of 2021, and so we were about a year in from launch, and we had done our pilot. The business was founded in April 21. We did our pilot launch in August of 21. So we were about 12 months into the business and 8 months post pilot launch. We had launched fully nationwide about 3 months before then, and we're doing roughly $30,000 a month or so in top line revenue, operating very lean. There was no paid employee. I was not paying myself at the time, and I had a couple contractors on that were helping, right? So we were operating this company very, very lean, and decided, okay, great, let's go out and do a raise. I had raised about $300,000 as a pre-launch through kind of a friends and family angel round, call it. So we had some capital that we were using during this pilot phase in the early days, but this was our kind of look toward doing a much larger seed round. So we were setting out to raise a $1.8 million round, and as part of that, decided to do a crowdfunding campaign. We did not want to do the entire raise through the crowdfunding campaign. We wanted to do a portion of it. So here was our process, about a 5 to 6 month process. The initial deal committee was essentially applying to the platform and having the initial conversations, submitting the initial pitch deck and investment memo. Once we initially got through deal committee, this is where we went through due diligence. So wrote probably answered 150, 200 questions from their diligence team. I was trying to turn this thing around as fast as possible, so I was staying up for hours at night answering, long questions about the business, which was kind of fun to put it in, but gets pretty tedious. But ultimately, we got the deal approved and went onto the platform, and then the launch prep took another 4 to 6 weeks. So this was like planning the campaign strategy with our venture analysts and internally, finalizing all the investment documents and getting those signed. There was also, on a Reg CF campaign, you have to host it on Seed Invest or whatever the platform is. So it was building out our profile there according to their sort of requirements and doing fact checking on everything we're saying and all that. So that took about that full process took about a month and a half for us. So then we launched. Campaign was a 60-day campaign. We actually made ours about 55 days. We had a reason at the end. I can't remember why. There was something that we needed to back it up about 5 days. But what I'll say about the campaign, and I'll talk a little bit about this on the final slide after this, is, we really thought about this as a marketing campaign, and we put all of the effort into this campaign the way we would a traditional marketing campaign. So we had almost daily plans for email outreach, social media outreach, announcements that we were going to make to with the company, so that we kept bringing new news into the conversation. And really, like, I think the focus of that is what ultimately made us successful. So, the launch day was heavily planned, as was the rest of it. And then we were constantly talking to iterate based on the new info that was coming in. Once we closed the campaign, that was the last day people could invest, but that doesn't mean that the money came in, right? You then have to go get the cash from all of these 450 people, which is Seed Invest leads that process. You have to finalize and sign all the documents, share all the purchasing agreements, and ultimately receive the money, which took about 5 weeks for us. So we launched the campaign in early July, but we started talking to them, I think, in like April, and we ultimately got the money in early October. So not a short process, but ultimately success. So our result, we raised about $775,000 from this 430 people. Our initial goal was 500,000, and we hit that goal about halfway through, and had to make we shut the campaign down for about 4 days while we decided we want to continue on, knowing that we have these high fees for any money that comes in the door, and ultimately decided, look, there's people who want to invest in this. Why turn this down? So a few reasons I think that we were successful. The far and away, the number one was, this was as like laser focused, disciplined of a marketing campaign as any other marketing campaign I've ever done. Daily tracking, omni-channel activation, one-to-one communication with a lot of our investors. Like, it was a really kind of specific marketing campaign. The other one was, we really listened to the platform team. We heard from the seed investing that a lot of these brands come in and they don't, they kind of want to do it their way. And ultimately that's not their expertise. Like, Seed Invest is the expert in this, or Wunderfund's the expert in this. So I would highly recommend listening to them. They've done this many, many, many times. And there were times we disagreed, and I would say, let's do it your way, because I think that makes us the more like best chance for success. And then the third one is, again, I feel like this is more of a nice to have than anything, but we just had a really good product fit for the platform. People think it's cool to be invested in a wine brand, right? They can tell their friends they're a small investor in a wine brand. They can become customers on it. It's an early adopter kind of feeling of finding this kind of fun new product. So we had a good product fit. This is not a requirement, but I think I would be crazy to say it didn't help us a little bit in some of the marketing. And we definitely leaned into that during the campaign around, this is your chance to own a percentage ownership of a wine brand. So that's it. If you want to check out the company and what we're making, reallygoodboxedwine.com. And again, please feel free to reach out if you do have questions. We spent a long time working on this and working and building this campaign, and I'm happy to translate any information your way.
Well, thank you so much. That was incredibly valuable. Yeah, you really walked us through everything. I have a little list here of like different questions I could think of along the way so that I could put them at the end. But
Yeah, same.
you really walked us through.
Thank you.
But of course, we will absolutely open the floor for even more questions. And thank you for generously also, offering to be a support character for any of these business owners and entrepreneurs here. That's incredibly valuable as well. All right, Marvin, I would love for you to go ahead and share with us all of your expertise and talk more about Wunderfund. Oh, and mute. And thank you for multitasking. I hope
Can you hear me all right?
perfect. Thank you so much.
All right, so thank you for taking the time today. And Jake, thank you for sharing your wisdom and your experience. And, you know, I think ultimately I can give you a little bit of how our experience is and how we walk our companies through. So let me just start off and talk a little bit about Wunderfund. Right. Are you guys okay? I'm not hearing an echo or anything. Okay, good. All right, so Wunderfund is, as you guys talked about, it's an equity crowdfunding portal, but we also do debt offerings and we also do equity. And the cool thing about doing equity or debt offerings is you can also do some kind of rewards-based kind of benefit for any of the investors who come through to you. So that can be an added bonus for anybody who's running a platform campaign. We like to say that anyone who comes through our platform, it's about social impact investing and building equity for all. And that's because we have a very specific mission. And our vision and mission is really to build equitable capital, founders who dream and those smart investors. And part of doing that is about fueling the moonshots and funding the dreamers, because we want to see Main Street and Silicon Valley all succeed. And what we've found is that there are millions of underserved founders that are out there, especially women, people of color. There's VC dollars that are mainly concentrated on the coast. And then look at all the small businesses that are across America. According to the SBA, there's as many as 31 million small businesses, and 80% of them are not using banks right now. So it makes you wonder, where are these people getting capital? And what we realize is that access to capital is a systemic issue. Call it bias, call it whatever you want. There's also the credit system, which some people might argue is stacked against people in some ways. And these are the things that we look at as our job is to level the playing field. We look at gender barriers. I mean, this is what you guys are doing over at AVH is so important. Obviously, you know all these statistics, but you know, ultimately, women are more likely to start a business than men, believe it or not. And you know, of these, we see a lot of disparity when it comes to access to capital. And so, part of the job that we see is really starting to break through some of those barriers and give the opportunity to, I think somebody said, democratize capital in a way. And that's what we do. So we like to vet the companies, not unlike what Jake was talking about. We're very selective of who comes onto the platform. We go through a vetting process. And what we do is then we underwrite the deals like an investment bank would do in order to file it with the SEC and then work together with our founders to advertise the deals. And that's the difference that when you're doing some kind of equity crowdfunding is that you are allowed to then solicit investors. And what I mean by that is that typically when you're raising capital for any type of deal, and the only people that you're supposed to be soliciting are what the SEC would call accredited investors. Now, the problem with that is that accredited investors are generally less than 10% of the population. This is what they call angel investors. These are people whose net worth are over $1 million, excluding their personal home, as well as they're earning over $200,000 a year. And they're a very small percentage of the population. And the problem is that not everybody, you don't know who all these people are. It's not like they're wearing a hat or a shirt that says, hey, I'm an angel investor. I'm looking to invest in your company. You have to have access to those. And that's part of the problem. But then, so, you know, our database consists of roughly about 15% of those users who are angels who are looking to get more deals. And that's one of the benefits of equity crowdfunding is that angels are looking to, from their perspective, is get in on deals without having to write an entry ticket point of anything like $25,000 and up. Now they could if they wanted to, and so they certainly do. It's just a matter of they can also invest smaller dollars if they want to. And then we also, the bulk load of our users are what we would call retail investors. And this is where, when you're targeting, as Jake was talking about, doing a very savvy marketing campaign, you're really targeting these investors. These are high income earners. They're the top 40% of their brackets. They're the majority of our users, but they're also ones who are inheriting wealth, and they're very tech or Robinhood savvy. So what I mean by that is that a lot of them have their own trading accounts. They want to get into private equity or venture or debt, but they just don't know how. And that's part of the opportunity when you're doing these types of offerings, is that you as a company are meant to wind up a deal in a way that's sophisticated enough that's going to provide some return on the investment. And that's ultimately what investors want. They don't want to just necessarily give a handout or a donation. Those are all great and fine. But when we look and talk to our investor base and our surveys, what we find is that they want to provide a social impact investment, meaning they want to make an impact, but they also want to see a return, and they're willing to take a little bit less in their return, knowing that their money's going towards something that's either greener or cleaner or something that's socially inherent there. So this is where, like I said, we've worked with founders of color, women, in every different types of deals, whether it's ventures type of tech deals to private equity, Main Street, as well as real estate deals. And here's the different types of fundraising that can happen. So there are, as Jake was alluding to, there's Reg CF, which is we call that the retail portal. Companies can raise up to $5 million using that regulation. There are some limits in terms of what people can invest in it. Angel investors can invest up to 10% of their net worth if they wanted to. You can advertise fully on those without anybody telling you that you shouldn't be doing this or whatnot. And you can do that from our website. There are two other offerings that can be used as well. One of them is Reg D. It's a private offering, but it's only available to angel investors. It does raise the limits in terms of how much you can raise on it. The only problem with it is that you can only advertise to accredited investors, meaning that anybody who invests in your deal has to sign off as an accredited investor. You have to have at least a one-to-one connection with them before you invite them to, let's say, a Zoom meeting or some kind of get together. But think of those as kind of like how financial advisors, when they're trying to, let's say, sign you up at their firm, they might invite you to lunch and say, hey, free lunch here, quote unquote. You sign up on their mailing list, and then you come. They're pitching these type of things. Those are the type of Reg D 506 offerings. But the nice thing about those, the real benefit, is that you can actually post the offering from your website. So it could be your url.com/invest. So if you have an investment page, that would just be powered by our technology on the back end. And it allows you to then completely control the advertising from your side. And then the last regulation that does public fundraising is what we call it Reg A plus. And Reg A plus is more of it's reserved for later stage rounds of capital. So maybe you've already raised capital in the private or public rounds, and now you're growing, you're scaling, and you want to do a series round. This is where I would recommend this is probably a good tool for you. You can raise up to $70 million on it. The nice thing about that, you can advertise from your own website. You can put all your investors under what we call a special purpose vehicle. So it looks like one investor on the cap table, and you can advertise it fully. The only downside to this of the Reg A Plus is that it's very taxing in terms of having to get regulatory approval. Usually we expect at least 3 iterations with the SEC. The SEC is very, very specific about what needs to happen when it comes to Reg A pluses. So there's iterations with the SEC, as well as it does require audits and or at least an audit from a CPA. So you got to factor in those kind of costs when it comes to jumping into a Reg A plus. All right. The way we work is similar to what Jake was alluding to, is that we'll look to source deals through our networks and go through all of our networks to scour for deals that are looking to raise capital. If they qualify for our platform, then we'll wind it up and then we'll syndicate the deal through our networks. And so we work with a bunch of different accelerators and incubators and venture groups and angel groups across the Midwest and South, which is where we are. We were founded in Cincinnati, but our networks there, we'll take a deal, we'll push it through there, and we'll try to get you in front of as many of these people as possible. They'll syndicate the deal through their networks, see if there's opportunity there. What we found is that the best use cases for equity crowdfunding is really filling the gap between crowdfunding capital and VC funding. So in that earliest stage, I don't know where all of you are in terms of where your company is. If you're in the earliest stages of raising capital, it's probably the best fit for CF side of it. Remember, we talked about 3 different types. But CF we found is the average raises is anywhere from 200 to $500,000. 262 is the average CF raise that we found on our platform, and across the U.S. that seems to hold pretty true there. And I'll just walk you through some of the opportunities that you can do when it comes to doing crowdfunding. Like I said, you're usually doing private raises, but if you're using a tool like crowdfunding, it allows you to launch your own ad campaigns. You can create your socials. You can do the in-person pitches. You can create ads out there, funnels. Those are really popular these days, where on Facebook or LinkedIn or Instagram, even some TikTok ones, you'll see opportunities to raise money. People will create offerings that you could click through. It's a funnel. It's basically saying, hey, you could earn a certain return on your investment. It gives you a really quick overview of it. People will then sign up for your email list. And what we usually recommend is like really start to use the CRM side of that, which is your people following up with those individual investors who sign up. And that's really the power of advertising, is it gives you the ability to follow up on any of those investors who might just click through and say, hey, this is interesting. I wanna invest. And the other thing is like really leveraging media. So I think this is really important, is for any crowdfunding campaign, is to start putting together as part of your strategy. I think Jake alluded to it very well. It's like you have to have a rhythm of news. So every day, every other day, or every week, you're going to have a series of different events or something new to share with the public, and being ready to amplify that through the media. Sending them press releases, and our analysts will actually kind of work with you to just kind of set a path out there. We can't do it for you, just under the regulations that we have. What we can do is amplify what you are pushing out there. So if you're pushing out there, we can then we can retweet it. But that's just because of our charter with the SEC. Here's just an example, and I'm actually part of this business too. I'm one of the owners too, and we don't just talk about crowdfunding, but we also live it too. Okay, so if you've ever been, Esoteric is the first Black and Asian-owned brewery in Cincinnati. We've raised over 900,000, almost 900,000 in equity crowdfunding. We ran a campaign for about 6 months. What was really cool about it is this, and that's the power of economic inclusion, right? And so what we found is that when it comes to the capital stack, because of the ability to do everything from advertising and press, and doing marketing campaigns, doing in-person type of things, we found a disproportionate amount of money that was invested from people of color. And what's important is that when you, especially as affinity businesses that are here represented here today, is that when you give the opportunity for economic inclusion, investment in private deals, which were traditionally only allowed for the wealthiest of Americans to participate in, when you give the general population the opportunity to invest in these deals, they will come out of the woodwork and support it. And that's where we see a lot of our deals. We see an over index in when it comes to affinity investing. Somebody mentioned earlier about your debt or your stack, right? And I think this is an important point. Any good entrepreneur, depending upon the type of business that you have, needs to understand that your capital stack isn't just necessarily going to be equity. It could also include debt. It could also include grants, right? And so regardless of the type of business that you're running, how you source that capital is going to be really important. There's a reason why a lot of banks will really look at your debt to equity ratio. And what they're trying to do is figure out, okay, how much of it is still owned by you? How much of a stake do you have that your skin in the game, if you will? And then how much other people have. And then they're trying to make sure that from a debt to equity standpoint, can you sustain the business with servicing debt at the same time? So there's nothing wrong with taking debt. There's nothing wrong with taking equity. It really just what matters is it really comes down to your business model and whether it's a right capital stack for your business model. It's a whole nother topic that we could talk about in terms of debt versus equity. But I'll tell you, it's really about managing that overall stack. Okay. So with that, let me stop there and answer any questions. I love what you guys are doing, and I would really love to hear a little bit about what questions you have for us about crowdfunding, but more importantly about raising capital in general.
Thank you so much. Wow, that was absolutely amazing, Marvin. And I'm gonna have to go look up esoteric. I'm gonna have to check that out. If you could, I think you're working on stop sharing, and we'll open it up to the group. It sounds like some of the over sort of take home notes here are that these platforms are really going to help us get access to these investors, right? Like that's a really, I feel like that's almost a no-brainer, but definitely good to know. Sounds like our entrepreneurs need business plans and marketing plans. They need to plan on leveraging those social medias and PR media. It sounds like plan on engaging with those backers and investors, that they're like, this is, that they're going to have some questions and some opportunities for that. Let's see here. Sorry about that. I'm going to unpin everybody. It's going to be great. All right, there we go. Expect fees, expect a little bit of cost here. It sounds like the B2Cs and then companies that are like contributing to the world in some positive way, right? In some big benefit, that those are kind of the top performers. And Marvin, I'm going to go ahead and put your email in the chat here too, so that everybody's got that easily accessible. All right, and absolutely, I hope everybody has questions. Hop on in, raise your hand, come off whatever you want to do, just chime on in. Oh, I love it.
I can kick it off actually with, so Jake, when I know you made that decision when you got to, 500,000 about whether you're going to go forward because of the fees, looking back on it, are you glad that you went with a closed platform instead of an open platform overall? Do you think you had more success that way?
Yeah, I think for a couple reasons, I'm glad we did. I think one is it gives us a little bit of the like, hey, we went through a due diligence as we go toward our next round of fundraising, right? And so I can, if there is pushback, which again, I think is overblown and I don't think as common as maybe was 5 or 10 years ago, certainly 10 years ago as this was getting kicked off. But if there is pushback, I sort of have an answer to that, which is, hey, we went through a real due diligence process with the deal committee, right? And we were one of 1% that got selected. So that more than almost anything, I think helped. But I think it would have been hard for us to rate. I think if you're on just one of the open platforms, you have to rely a lot on your own personal network or like the one circle out friends who are saying, hey, my friend is starting this. Why don't you think about investing? And the fact that we had Seed Invest, who was, in collaboration with us, reaching out to their investor network, was incredibly powerful. And I think is where we got the majority of our investors. I mean, I certainly have some of my network who invested, and some of them were some of the bigger checks in the crowdfunding campaign, which is great. But we have hundreds of people who I had no relationship with before that came because of the Seed Invest network and because they were doing it on our behalf. So I'm happy we did it. I think it was the right choice for our business. It's not the right choice for everybody's business, as Marvin said. Like, it's very your decision on financing your business, what kind of platform, whether you're doing debt or equity or a combination of both or something else, is so reliant on your industry and then what your personal goals are for your business.
Yeah. Do you know whether how Seed Invest has changed now that it's part of Start Engine? Like, is it still its own sort of entity, even though it's owned by them?
No, it is. I don't even think they're taking on investments anymore. I would say, yeah, when I just go to Start Seed Invest, it just switches over to Start Engine.
I
So,
know that's, yeah, I was going to
so,
include a link
yeah,
before you and I met, but yeah, and I realized that. So,
so I think
okay.
I don't think so, but there are others out there. Wunderfund clearly is an option.
Yeah.
Republic is out there. So there are some others out there. We just happen to go with Seed Invest because we got furthest along with them the most quickly, honestly. Like, we had great conversation with their team. And they believed in what we were doing. And we're so reliant on, in a closed platform like this, you're so reliant on the team, like, really believing, because that's what's going to help market this deal the best. And we just felt really great about the team.
Agreed. Marvin, is your platform a closed platform or an open
Yeah.
platform?
Yeah, just if I might add a little bit of context and color to that. I do think when it comes to choosing those types of those avenues and what you call closed or open, we call it Reg CF versus Reg D, and that was the slide I shared with you before.
Yeah.
And ultimately, you really have to think about one, what's the goal, original goal or ultimate goal of the company? If the goal is to get capital that you're going to go raise more capital at some point later, and you're going to scale it, and you're looking to exit the company, and you want some like strategic capital, then I think doing a more closed platform is probably a better route, right? That, in my experience. There's nothing wrong with doing the open platform. I do think you can manage it now. As Jake was saying, there's more openness for venture capital and other private equity for that. And there are tools to manage that. And you might have seen in the deck, as I shared, is that there's this thing called a special purpose vehicle, or it's an SPV. Okay. And so there is a new tool that the SEC allows for anybody who's raising capital, especially using crowdfunding as a tool. It's called a crowdfunding SPV. What that does is it allows you to then partner up with an organization like us, for instance, or some capital group who is going to represent the big investors on a cap table, and all of the small, $50 investors, retail investors that come on board, then they all fall under this umbrella of the SPV. And the rights in terms of voting, in terms of decision rights and so forth, then get proxied to the CEO of the company, that being you. And that way you can then go back, and when you're raising more capital in the future, again, if that's the ultimate goal, is then you can look at your cap table and say, okay, hey, we've got one line. There might be 100 people under it, 400 people under it, but it's all managed by your company in a strategic way, so that they all have a certain. You're not going to get phone calls from somebody in the middle of the night who's a $100 investor saying, hey, where's my money, blah 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 blah, who might not really understand the long-term ramifications of what private equity is all about. So this is some of the things that venture private equity are always concerned about, is having the tail wag the dog in that way, the overall cap table that way. So that was my 2 cents on that.
That's really helpful. Thank you. Marvin, how do you decide whether you're going to give somebody the access to the investors versus debt?
Sorry, I missed what you were saying there.
How do you decide, like, if somebody is proposing that Wunderfund, works with them on their business, And you said you offer the debt and the equity
Funding.
funding. How do you decide which
Okay.
you're going to offer?
Say one more time.
When somebody comes to work with you as a company, and because you offer both the equity funding and the debt funding, how do you decide which one you're going to offer them?
Okay, so it's a great question. So, generally when we go through our diligence process, we really want to see the financials of the company and see how the company how it makes money. What's the mechanisms, revenue streams, and we want to see the profit in terms of like how do you manage the profit side of it? And when it comes to the type of business, a very simple example. So let's say you're a bakery, and if you're a bakery and you are renting a business or renting a building, I should say, and in that you're installing equipment, there's a certain capital stack to that you can track. You know what your rents are going to be or your mortgage. You know what how much capital you need for it, and then you know what your input costs are there, and then you also what your throughput is in terms of number of people you need to get through the door and how much revenue and profit's going to be there. In that, you also know that in a very physical business like that, there's only so many ovens that you have, and there are only so many croissants you can make or cakes that you can make in a 24-hour day. So your revenue is by definition capped in that way, unless you were to invest more capital and so forth, or double your locations, et cetera. So from there, we can forecast out based upon your numbers what the serviceability of the debt would look like, and a banker might be able to do that. And the banker would then tell you, okay, this is how much debt you could actually sustain in order to finance that business. Okay, now in that process, sometimes when you're looking at the stack, you might say, you know what, I don't necessarily want to take out that big of a loan, and servicing that amount each month might be a very big risk. So then you would look at your capital stack needs in terms of the use of funds and the kind of equipment money that you need to put in there. And you might say, hey, you know what, I need $100,000 of equipment. I'm willing to give a percentage of my business to an investor who might come along and say, hey, I love the social mission of your business. I would be happy to then invest that $100,000 in it. And now the question of that 100,000, how does that compare versus the equity, or I'm sorry, the debt? And so usually equity is more patient than debt in that regard, meaning you don't have to service the debt, or you don't have to service the equity, I should say, right away. Because usually if you take a loan from the bank, if it's an SBA, they're going to want you to start paying it back as soon as you open your doors. If you take a traditional loan, they're going to want you to start paying it back within 60 days. So you think about the business and just the amount of time it might take to start up the business and start cranking out baked goods or whatnot, then that's when you start servicing that piece of it. So if you're a patient investor in equity, you might look at this and say, you know what, you don't have to pay me back until a year from now, once you get the business open. And at that point, I recognize this isn't venture, all right, but what I want might be a preferred equity. And what that means is preferred equity is similar to like a bank note, except it's like, I guess the better way to say it's more like a dividend stock, if you will. So if you bought Coke today, or Procter & Gamble or whatnot, it's not going to be a high growth tech stock like Nvidia or Apple or Microsoft, but you're going to get some kind of dividend, or you would expect it, and you would expect the business to be pretty stable. And so every year, then whatever profits that gets spun off, then the entitlement to those profits is really the percentage of ownership that somebody who's put equity into the business would be entitled to. So that, in a nutshell, is kind of how we would look at the deal, structure the deal based upon how your business model is built.
Okay, that's really interesting. So it could be just that combination of things depending on what you need for what. Yeah. Jake, did you use your money just to produce the product, essentially?
Oh, I mean, our use of funds was production was certainly some of it. Growth capital, salary, and
For a change, right?
I think when I say growth capital, I mean marketing.
Okay.
And then just sort of generally strengthening our supply chain. I would say some of it went into, we don't have heavy R&D because we're not like developing new innovation within the boxed wine space, but we do some. We innovated on like our shippers to give a more stable shipping so that we didn't have as much damage in shipment and a better presentation. So some of that kind of stuff that's light R&D, I would say. And then we used a little bit of it for to kick off our wholesale businesses, which is a little more like almost more like T&E, like travel to meet with distributors. And there's not a lot of upfront costs. Most of it comes in like tastings once you're in market and actually in a retail location. Then you have to use marketing or other like retail and like incentives for the distributors. But there's some upfront costs there. I would say most of it was production, marketing, growth capital, and sort of like infrastructure of the business. Yeah, and salaries.
What's nice is that you could I mean, it sounds like you really got to utilize a really wide variety of assistance, right? Like, I mean, like you got to really go through and be like, actually, we're going to put a little bit or a medium amount into a lot of different things to
Totally.
get you guys moving and grooving in all the right ways.
Oh yeah, and I think like one of the most important things that any investor is going to look for, whether you're doing crowdfunding or traditional fundraising, is what's your use of funds, right? And that's where this plan, your projections and your pro formas come into play. Yes, on revenue growth and what is your P&L projected to be over the course of a 3 to 5 year period, but also how are you going to use this money, and does this make sense for the business?
Yeah. Wow. Does anybody else have any other questions?
And we should be very oh, Sarah, hop in there. Go for it.
My question is regarding, and I think it was Wunderfund, but about having a business plan. What exactly are you looking there for? Like a business model or like a big, like 30-page long Word document or what?
Yeah, no, that's a good question. You know, I think ultimately a good business model, it really defines what the addressable market that you're jumping into. So if you're in baked goods, then you're a bakery, all right? If you're in beer, you're in breweries. If you're in tech, then which specific area of tech are you in? And so the business model should then deep dive into one, the problem you're solving, the product or solution that you're providing, how big of a market that you're able to capture in that in terms of your market share, and then all your projections of that are based upon the revenue streams of your business model. And just defining what those revenue streams, I think, is really important for companies, because the plan is really meant to really be choiceful. It's one thing that we used to always talk about when I was at Procter & Gamble, was that, you know, you are built, if you're going to be working on the Tide brand, you know, and you're making laundry detergent, then your job is to manage that one product. It's not to manage all the other, you know, Gain and Cheer and all the other things. Your job is to manage that one product. So that one product might have 3 or 4 different SKUs or variations from it. And that's the singular focus that you have, is building those things out. And as Jake has, I see there's I think 7 or 8 different products that are right there. Those are his SKUs. And so he's very much focused on delivering those SKUs to his consumers. And so, you know, part of the business plan is just to understand, of all those SKUs, how much is each one contributing in the portfolio? I'm sure there's different margins on each of those products. And of those, you know, all that adds up into a plan that can show that there's a consumer demand for it. And so at the end of the day, you know, it's really about churning that, making it more efficient, optimizing that whole thing. And the plan should then reflect that. And what builds confidence with investors is the fact that you can repeat that. And because nobody wants you to have to reinvent the wheel every single time or every year, whatnot. What they want to do is just say, okay, hey, you've already proven that you've built this kind of machine that's churning this stuff out. Then if we just give you a little bit more money to give you more access, more distribution, more inventory, more marketing dollars, then you could just replicate the same thing. And so that, in a nutshell, is just the basic nuts and bolts of kind of the business plan. And if you can effectively articulate those type of things, then I think any business can be successful. as long as it's reproducible and they can show that those things are happening.
Yeah, I feel like the long and short of that, right, was of doing the background research of looking of, all right, so this product has brought in this kind of income so far, and based on and we've had this share of the market, and we're looking to either continue to utilize that share of the market or maybe grow or expand that market, and that's how we plan on doing that, and then that's going to equal this income moving forward. So
Yeah,
a little
no, I
bit
know
looking back and a little bit looking forward.
I guess maybe I was unclear. I guess more of a question more along like formatting or like functional, like, right, you can have a plan, but it's like, okay, like you could have a 300-page document that was super, like no one's gonna read that, right? Like it's more of that kind of
I have a
question.
pretty strong opinion on this for startups. Is a business plan for Procter and Gamble and a business plan for, because I was at P&G for a while as well. So Marvin and I share that background. The business plans were at Procter and Gamble and the business plans to the startup rights, I think, are very different. I do think that both need them. And some founders in the entrepreneur space like kind of talk down on business plans, are like, that's crazy. Like, who writes business plans? I actually do think business plans are important, but I think a business plan that's 3 to 5 pages long that is really helpful for you to like take what's in your brain, document out exactly how this business works. Like, what is my objective as the business? What's my product? Who's my target audience? How am I going to produce this thing? How profitable is it? And what are the actions that I'm going to take to go grow it? Like, I think a startup business plan, more than any other type of business plan out there, needs to be like incredibly actionable so that it's actually helpful to the founder. If we're just writing 30-page documents because we think that we're supposed to, we're spending our time in the wrong place. And yes, sometimes there may be use cases where certain investors may want to see a longer business plan. Great. They'll ask the question, let's go do the research to build that. But in the earliest days, like, your most valuable resource is time. And you might be able to write an initial business plan in an afternoon. It won't stay exactly like that forever. I think it should be iterative, and it's a journey. Like, a startup is inherently messy and is like, you're trying to figure things out. You're going to get new information. So like, it's a working, living, breathing document. But you probably have, for your business, you could probably sit down by 6 p.m. tonight, you could probably write 2 pages about what it is exactly that you want to do and how the business operates, and then sort of use it as a template for going from there. So I encourage early stage, and I don't know what your business is or where you are in your journey, but I encourage early stage founders to just like put pen to paper, write 2 or 3 pages. It doesn't have to be super detailed. Put a rudimentary financial model together, and then sort of like check it as you go and use it as a working document.
I love that, Jake. And we do have, I just put in the chat a link to our 1-page business plan. It's very, very simple, super simple.
Yeah.
It's, what do you do? Who wants it? Why do they want it?
Yeah.
How do you get it to them? Super, super simple, but I love the idea of taking that, spending an hour working on that or writing it down, or 10, 15 minutes. And then, like Jake suggested, expand that into a couple of pages of just talking about what you do and all those, just expanding on each of those questions, and then building out that financial model, which again is like, where's your revenue sources? How much do you make from them? What are your expenses associated with those, right?
I've always found the financial model is also the most intimidating for most people. And so the way I like to do it when people are sort of stuck with the financial model is like, sit down, don't get off your computer and just start writing. Like, how many units am I going to sell? Great. I think I'm going to sell 100 of them. What's my revenue from each one? Great. 30. Okay. That's $3,000 in revenue. Okay. How much does it cost to produce? Great. It's that, like, you just start like chipping away at like, how does the business work? And it's like, okay, next month, how many do I think I'm going to make? The following month, do I feel like I can reduce the costs over a 6-month period of time? And as you start to write these things, all of a sudden you've just sort of created your financial model. I mean, that is the financial model, right? It's a forecast to what the P&L of the business is going to look like over time. But if you take it one step at a time with what you know today, I find it to be actually a pretty fun exercise. Just it sort of like clarifies the business for you.
Yeah,
I
and it's
agree.
really helpful to have that like yesterday's to help guide tomorrow. So you're not just
Yeah.
being like, oh yeah, like, I don't know, like I could probably sell 100, but like, have you sold 100? Right? Like, what did we do last month? Like, why would we, so like we'll be able to do it again next month. Maybe.
And what will it take to do that, right? Do you have to spend more on marketing? So then, yeah, just kind of the assumptions that you make and working backward from those. Yeah, I think that's great advice. Is that helpful, Sarah?
Yeah, yeah. I mean, we have like a big financial model and pieces about it. And probably the plan is like, because it was one of those 30-page documents that are not useful, so that it just gets written once 3 years ago and sits on the shelf. So yeah, I mean,
I think they're really like, I have a working, breathing, living kind of whether you call it a business plan or call it like our operating, whatever you want to call it, like I think a business plan that is useful is incredibly useful, but I think a business plan that's useful looks very different for a small business than it does for a Procter and Gamble, right? They're just like talking, we're in just different.
I used to do that at Emerson, so it's the same thing. It's like, these things that took like an army of people 3 months to make.
And then you present to leadership, everyone aligns, and you move on to the next thing, right? Like it's
Right.
for a startup, man, like your time is everything. And what startup, small business, like your time is everything. You're so resource constrained. So like, let's make things that are useful. Is kind of my, even internal, let's make them useful.
Wow, thank you guys so much. Jasmine, you want to close us out?
Yeah, and I want to close out with a shameless plug.
Okay, do it.
So everyone, mark your calendars. If you are in the Cincinnati area or you just really feel like visiting us next month, April 27th. It's a Saturday, and it is our women-owned business crawl. It's an all-day event from 11 to 4. You're going to come hang out with us here at Aviatra, check in, grab a shopping bag, and we're going to give you a map of 30 plus businesses that are women-owned in the area, and you're going to eat, drink, and shop and have a great day. And we would love to have you here and have you join us and support our community.
Oh, I'm going to put the link in the chat.
Brilliant.
It's easy. It's wobcrawl.com.
Women-owned business.
Yes,
WOB.
for women-owned business. Yep. There it is.
All right. Well, thank you so much. Yes, absolutely. Thank you so much, Marvin and Jake. You guys are just incredibly valuable resources and so generous with your time and your experience and your knowledge. And we're so just grateful to have you. And
yes,
everyone just stay
Thank you both
connected.
so much.
Let us know how we can help.
Yes, and thanks to Pay Forwards for sponsoring the webinar. Thank you, everyone. Talk soon.
Everybody.
Thank you.
Talk soon.
Bye.
See you guys.